Hi, everyone, and thanks for joining us today. I'm your host, Caitlin Cormier. We often hear that money can't buy happiness. And while that may be true, I think most would agree it can certainly be a stress reliever. And that's something many investors could go for right about now. In the 2022 TD Wealth Survey, suggests Canadians are an anxious bunch when it comes to their finances, especially those aged under 35. 80% are concerned about housing prices, 71% are spooked about rising interest rates and market volatility, and 67% are worried about their earning capacity. Meanwhile, FP Canada's 2022 Financial Stress Index found 1 in 3 Canadians surveyed said financial stress is leading to anxiety, depression, or mental health issues. So if all these stressful experiences can have a negative impact on our well-being, it's clear investors may need ways to better manage their feelings and responses to them. That's where Chantel Chapman comes in. She's the founder of Trauma of Money Method. It's an approach to healing trauma in our lives that may hamper the way we handle our money. Chantel will explain how traumatic experiences, financial or otherwise, can warp our feelings towards our finances in ways we might not realize. Then she'll share some common instances that can lead to behaviors that may negatively impact investment returns. Lastly, she'll share some strategies for dealing with trauma and hopefully overcoming those nasty habits. Chantel, thanks so much for joining us. But first, I have a trivia question for our audience. An investment plan may help investors reach their financial goals, but emotional decisions can often interfere along the way. What percentage of investment gains can be attributed to an investor's asset allocation strategy? Stick around till the end of our discussion and we'll reveal the answer. Okay, first off, tell us a little bit about your personal story. What sorts of financial stresses did you have in your life that motivated you to get involved with financial literacy and counseling?
I grew up with a single mother and we lived in poverty. We lived in social housing. And there was experiences that didn't feel the most safe and felt a little bit chaotic due to the environment. And in those circumstances, I developed a very strong belief that money equaled safety. And if I had a lot of money, I would be safe. And that was one of the things that drove me down the path of wanting to work in finance, wanting to become a mortgage broker. And as I was in that career, I was noticing a couple behaviors that were really unhelpful within myself. One, I was filing my taxes late all the time. Two, I was constantly overspending and racking up credit card debt. I was not putting away any money to invest whatsoever. And three, I was under earning and I was basically offering my services in what we would call like a people pleasing manner in order to get really the approval of others, but it was impacting my income. And then when I look back at my spending and my overspending and the credit card debt, everything at some point was connected to getting approval of others, like leasing. I in my early 20s, I leased a brand new Audi because that's what the successful mortgage brokers were driving. And I had no business doing that. I couldn't afford it. But it was like that desire, that need to look like I had money and get the approval of others gave my nervous system a sense of safety. And it was through exploring those deep behaviors, because I knew the financial literacy. I knew what was right and what was wrong, but I couldn't shift. And it was through looking at those behaviors and going down this very extensive path of research around trauma, addiction recovery, behavioral economics, behavioral science, the psychology of scarcity, and studying all of these different areas that could potentially impact the relationship with money, I knew I finally saw some clarity on what was driving the behaviors. And then that led me to wanting to expand this out and teach it through the trauma of money.
That's so fascinating. And some of those things we may be doing, that kind of taking away the value of the services that we provide, providing them for free. I'm sure a lot of people do those sorts of behaviors without even realizing that that's, harmful. It's really, really interesting to think from that perspective. So let's unpack the jargon a little bit. So what is money trauma and how can it manifest in someone's life?
The way that money trauma is mostly defined is something happens specifically around money and it results in trauma to the person. So we have a list of financial trauma or money trauma. So that would be growing up in child poverty, experiencing financial distress for a long time, like more than 3 months, loss of a job, inability to retire, loss of a significant amount of assets, economic or financial abuse within a partnership, between you and a business. So very specifically, there's like something with money happened, resulted in trauma. And of course, it's going to impact your interactions with future dealings with money. But at Trauma of Money, we take this more expanded view, and we believe that anything that has happened or hasn't happened in your life that has resulted in some sort of trauma, and I'll explain a little bit more what trauma is, anything that has happened that has resulted in trauma, even though it has nothing to do with money, can impact the relationship with money. And the reason why is because at its core, trauma is something that happens or doesn't happen that impacts our sense of safety and our sense of self-worth. What does money represent in our society? It represents worth and it represents security and safety. So these two things are really directly linked. And what essentially happens when a trauma takes place is the brain is stamping that and as a memory in order to protect us in the future. And so what ends up happening for the neuroanatomy of trauma is a portion of our brain we lose access to anytime we interact with something that feels similar to the original trauma. Okay? So there's a great teaching that one of our trauma therapists used when she teaches kids. And I always love to use it because it explains it so well. So if you make a fist and you put your thumb underneath your hands, this is your brain, okay? And this front of your brain is called the prefrontal cortex. So this is the prefrontal cortex. This area of the brain is associated with executive decisioning, impulse control, that like expanded thinking that's outside of this or that thinking, the ability to see multiple options, fluid intelligence. This is the part of the brain that we really need when we're interacting with our finances, okay? So what happens when we interact something that might arouse some trauma or a negative memory in the past, this little area in the brain called the amygdala is like the fire alarm. And it's all of a sudden like, uh-oh, this feels dangerous. This feels unsafe. And it starts alarming the brain. And what happens is we flip our lid. Our prefrontal cortex goes offline and we move into the survival part of the brain and into this older part of the brain. And in this older part of the brain, we go into this or that thinking. I need to make a quick decision to survive. And then what ends up happening is this part of the brain signals to the brain stem, which is here, or the back here, that tells our body to react accordingly. So this is where maybe our temperature increases, or maybe our temperature drops. Maybe our heart starts racing. Maybe our breath gets really shallow. Like the body is reacting. And there's multiple different reactions like fight, flight, freeze. And there's another one that's being more researched now, which is called fawning. Guess what that is? People pleasing. So when I learned that, I'm like, oh, all of these money behaviors are a trauma response. I'm people pleasing. My nervous system is going to fawn. And so what we want to do with these teachings is anytime we're interacting with our money, whether it's the market is really volatile right now and I'm starting to go into some like scarcity thoughts. The first thing you want to do, you want to get that prefrontal cortex online, right? And we can do that by using the body, by using breath and or slowing down the heart rate to basically go backwards and to say, oh, guess what, brainstem, we're actually good. And then we can bring that prefrontal cortex back online.
So we talked about a couple different sources where it could come from. So what are some other sources, potential sources of money trauma?
Yeah, so we use this 6-layered model, and this was really the foundation of the creation of trauma of money. And after I spent many years researching all these different areas, I asked this question, like, what impacts the relationship with money? And we came up with this model, and the first is generational or intergenerational trauma. So this is trauma that your ancestral lineage, even maybe your mother, your father, your grandparents, that they have experienced in their lifetimes, okay? And we know through more research around epigenetics that it is very possible for these traumas to be passed down even on the gene level. But not only that, from like the nurture standpoint, the stories that you learn through your ancestral lineage. So if you go back and do like an intergenerational mapping of your family, did your family immigrate? Were they in war? Were they in the Great Depression? Did they experience scarcity? What was their relationship with money like? And you're going to start to see things that your family has experienced that maybe created certain beliefs around money. And then we get raised by those beliefs, right? So generational trauma. The second is relational trauma. So this is trauma that we experience in relation to someone else or something else within our lifetimes, okay? So this might be a fall down the stairs, a car accident, abuse. This could be bullying. This could be the math trauma. This could be a chronic illness. This could be living in financial scarcity. This could be ongoing experiences of trauma, like living in a police state as a person of color, or microaggressions through racism. So like these are all forms of relational trauma. The next layer is called societal trauma. So this is trauma that can happen as a result of the dominant culture or the society that we live in. And there's multiple examples of this. One would be the trauma of poverty. One would be the trauma of the wealth gap. Another that we talk a lot about is consumerism. And one of the main narratives of consumerism teaches us to disconnect from our emotional feelings. And so what we see a lot of times with social media and Instagram, we see this message. Are you bored, tired, lonely, inadequate? You should never feel that way. And if you do, something's defective. We want you to be on a dopamine treadmill. So go and buy a product or a service. Go look at your friends' accounts and feel a false sense of scarcity because you're not in Europe right now and they are. You know, it's like this constant reminder, you should never feel anything but happy. And if you are, fix it. Well, that's just not the truth of who we actually are. The next layer, so this is the fourth layer, is systemic trauma. So this is an acknowledgement that there are systems that exist, systems within governments, within organizations that have elevated some and marginalized many others. And we cannot ignore that when it comes to money, because these systems, even though they may not exist now, we still may feel some of the impacts of them, right? The fifth layer we call the laws of nature. And this area that impacts the relationship with money is basically being disconnected to beliefs that you want to have around money. If you really look at a lot of financial literacy teaching, there's a lot of, if you do this, you're good. If you do that, you're bad, right? Like to be good at money has to look like this. And what we really teach is that actually causes a lot of shame, and it disempowers people to not make the right financial decisions for themselves. So in laws of nature, we use this to uplift people's own worldviews around money, right? So let's say that, you're investing and you really only want to invest in social ventures or a social impact fund. And then the finance people are like, well, that's not as profitable and this and this and this, and it's about profit. And you're like, well, my values is this. I want to do this. Like, we have to be able to uplift what is connected to our own values. And then the last layer is financial literacy, of course, right? Because to really heal the relationship with money, we need to empower ourselves with financial literacy and financial education. But in trauma of money, we specifically have financial literacy last because of what I showed you with the brain. If the prefrontal cortex is offline, if we flipped our lid, we cannot interact with financial literacy. So we go through all of this exploration, we get our nervous system regulated, we bring that lid back on, prefrontal cortex here, then we interact with financial literacy.
So what are some financial disorders that might develop due to unresolved money trauma?
Okay, so I'll go through them. So they're in 3 different categories. The first one is called financial avoidance disorders. So here we would see financial rejection. So financial rejection is a very sneaky one, and oftentimes this is subconscious, and it's basically where there's like a rejection of money. So let's say you get money, you spend it right away, or you can't save, or you can't invest. It's just spending right away, or you under earn, or you undercharge. And it's like there's this belief that you're not worthy of receiving. You're not worthy of investing in yourself or investing in your financial portfolio because something to do with creating wealth feels wrong to you. And, if you grew up in a way where you heard narratives like money is the root of all evil, you don't want to be hedonistic because that's greedy and evil, you may have developed one of these beliefs that could result in this subconscious financial rejection. The second one is financial avoidance or financial denial. And this is not looking at bank statements. This is not making the leap to make an investment, just keeping your money under your bed. This is not doing your taxes, just avoiding, denying. It's not even there. You're dissociated with it. The next category is called money worshiping disorders. So one of them would be compulsive spending, compulsive shopping, overspending, gambling, or taking excessive risk, workaholism. So all of these would be like money worshiping disorders. And then the next category is called relational money disorders. So this is where we see financial infidelity. So like not disclosing things about your finances with your partner if you have that sort of relationship. Then we see financial enmeshment. So this is having, it typically happens between parent and child where there's really unhealthy boundaries around money. So maybe the parent has a lot of money stress and they're disclosing way too much of their money stress to a young child. And the young child is not mature enough to understand the context. They just kind of see stress and terror in the parent. The last one is called financial enabling. And this is my personal favorite because this is me to a T. It's where we use our money as a please like me fund. So this is financial codependency. It's under earning because I'm giving everyone a deal, constantly overspending on friends and family when you can't afford it, racking up credit card debt so you can have the cool Audi and the nice clothes so people accept you. Also, this can be excessive risk taking. Someone comes to you and says, hey, let's go into this business deal. Hey, invest in this deal I got. And you can't say no because you don't want to hurt their feelings. And then all of a sudden you're taking this massive risk. It can also be workaholism. So I at times have been a workaholic, and I was never a workaholic because I wanted to acquire more wealth. I was a workaholic because I wanted to please the authority figure because of some of the trauma that I experienced, right? So those are some of the financial disorders that we work with and how some traumas can manifest into different behaviors.
Now, the big question is, what can we do to become aware of experiences that may be tied to money trauma and hopefully better manage them when they arise?
Imagine a scale of 1 to 10. And 1 to 3 is what we call hypoarousal, or this is like freeze or collapse, okay? And then 7 to 10 is fight or flight. This is hyperarousal. This is like anger or running or, even people pleasing as an action, okay? So this represents our nervous system. So in phase 1, when we're interacting with our finances, we ask, where am I at in the window of resilience? Now, the numbers I didn't mention were 4 to 6. 4 to 6 is your window of resilience in the middle. This is the place where we find an optimal state of effectiveness in a stressful situation or in a situation that's upsetting. So what we're not saying here is you need to eliminate all upsetting situations, because you can't do that if you're going to live on this earth. Things are going to be stressful. We're just trying to find a way where we can create a healthy environment for your nervous system among stress so you don't cascade into a trauma response. And we call that the window of resilience. So what we want to do is we want to ask ourselves, what can we do to move into that 4 to 6 range? Okay, so depending on what side you're in and what works for you, you would choose from multiple different ways to regulate the nervous system. So I can list some off. Breath. Can we lengthen the exhale, deepen the inhale? Can we breathe for a couple minutes, get tuned in? Can we bring some mindful awareness to what's happening? Wow, I'm noticing I'm feeling really stressed out right now. What is stressing me out? Okay, like just bringing mindfulness to that. Cold water. Cold water is amazing if you put it on your wrist, the back of your neck, splash it on your face. This is a really good way to kind of stop the nervous system from wherever it's stuck. Singing, humming, chanting. Movement, dance, calling a friend, socializing, laughing, petting an animal, getting some of that oxytocin released, which is that bonding neurochemical, giving someone a hug, going for a run, going out in nature, expanding your view, just going out and looking at a wider view can help bring us out of that like tunnel of scarcity or that narrow trauma state. The next thing we want to do is we want to identify the narrative that's present and really tap into whether it is the truth now, okay? Because oftentimes when we're interacting with money, there's someone else's voice, there's someone else's narrative that's coming in that usually has some shame associated with it. So our question we love to ask is, whose shame is this? So there's just really identifying the narrative and separating it from your innately worthy self is really helpful to bring back some agency in the situation around money. The phase after that, we call the vision phase. And this is where we get to, once we're feeling more regulated, we get to connect with what is important to us. What is valuable to us? What type of life do we want? What matters to us? And being really strong and grounded in your vision is one of the best financial literacy tools.
Okay, now that we understand the approach to dealing with money trauma, let's get into some common examples that investors might experience and what they can consider doing to address them. First, let's talk about a situation that many of us have probably experienced: making a poor investment decision that lost money. What sort of behaviors might this lead to that could hurt an investor's performance?
Yeah. So, I mean, if you make an investment decision that lost money, and you hold too tightly onto that memory and experience, of course, it could result at the extreme in excessive risk aversion, right? So missing out on future opportunities because you're really stuck in that past negative orientation, right? And investing is you win, you lose. It's up and down, and that's part of it. And to base all future experience on one negative experience is going to cause a lot of suffering for someone's life. So what I would recommend in that situation is acknowledging the focus on the past negative and seeing what can be done in a way that feels nourishing to the nervous system to dip your toes and explore other ways to invest. So you're learning from your situation, but it's not inhibiting you from moving forward.
Another common situation is the opposite of our first example, making an investment decision that performed exceptionally well. This obviously sounds great, but how could early success potentially warp an investor's approach to investing decisions?
Well, yeah, it's going to be the exact opposite of that. So if you have a past positive orientation, it may result in excessive risk taking, right? And then future disappointments. So it's really like, I think all of it comes to finding that middle path and finding the neutrality in the relationship with investing where it can be ups and downs, right? And maybe because of your experience, it does increase your risk tolerance. And that's absolutely okay to do that. But I think it has to be done with the prefrontal cortex in mind, meaning, do you have enough money to cover your expenses if you lose this money? Like the riskier you go, you have to be very sure that the impacts on you are not going to be quite massive. So there's a lot of weighing, there's a lot of cost benefit analysis that needs to happen, which really requires the prefrontal cortex.
A third situation that's common among investors is experiencing anxiety during market volatility and not knowing what to do. How can instances like this create money trauma?
What we found in our research is that when someone is in actual financial scarcity or actual time scarcity or connection scarcity, or they believe they're in scarcity, the brain doesn't know the difference, right? So if you're looking at the volatility of the market and you're like, oh no, it's going down, I'm going to lose everything, right? You're creating scarcity in your brain, even though that might not be true, even though you can pay your mortgage, you can pay your food, you can buy your food, all that stuff. The scarcity is happening in the brain. And when I told you when a trauma response happens, we lose access to the prefrontal cortex, scarcity is very similar. Scarcity does a couple things. It makes us have tunnel vision. So we become hyper focused on whatever we believe is in scarcity. We may become obsessive about the market and what it's doing, right? We also lose our inability to create long-term goals and have long-term thinking. So in scarcity, we're like, I'm losing money right now. And we lose the ability to see that, well, what happens long-term in the market, right? We lose goal inhibitions. We also experience something called bandwidth tax. And this is where essentially, because we become kind of really hyper-focused on this, whatever we feel is in scarcity, it's like having 100 tabs open on your computer and the entire operating system slows down. This is what's happening to your brain and body when there's something in there that feels scarce. We get tired, we get exhausted. And in that state, we have a really hard time making decisions. Our impulse control is impacted, and we also experience something called temptation tax. So we're more likely to act out on temptations when we're in a state of scarcity. And I think it's really important, if you are having those feelings of scarcity when within market volatility, that you take the same approach that I described when I was talking about bringing your prefrontal cortex online in a state of trauma is, how do we regulate the nervous system? And let's actually look at what's happening here, okay? Am I okay to leave my money in the market right now during this tougher period? Or do I need funds right away? And if I need funds right away, do I need to pull them out of there? Or is there another source? And we need to have like our full range of cognitive capacity to make these decisions.
Thanks so much for shining a light on how money trauma might impact our investing, Chantel. And we're going to keep the conversation going with our audience during our live Q&A in just a moment. But before I do, I wanted to pick up on something you mentioned about keeping those bigger goals in mind when finding a way forward in our money trauma. That's something the Goals Tool and Web Broker might be able to help with, so let's take a tour. All right, here we are. Let's click on the goals homepage, which is the fourth tab up here on the top. This is where we're going to come to start any investment goals that we would like to set. What we're going to do is we're just going to click the Get Started button here. We're going to choose what our investment goal is. So we have a few different options: retirement, major purchase, or just for your money to grow, whichever type of goal you're looking to set. For today, let's go ahead and use the My Money to Grow option. We're going to put in our current age. Let's just say we're 25, and let's say we want to have $1 million. And let's say that we want to have that money by the time we're age 65. And let's just say the name of our goal is Future Wealth. Perfect. So this is kind of the basics. So let's get started with that goal. So the first thing that's really important for us to select is our investor profile. So this has to do with what risk we are willing to take within our portfolio based on a few factors. So that time frame, making sure kind of what we're comfortable with emotionally, what we can kind of weather as far as ups and downs, and what we're looking for as far as a return goes. So we have our conservative, moderate, and aggressive portfolios available, or we can create a custom portfolio if we already have an idea of what our portfolio is. We can watch a video here, which gives us some additional information on those portfolios, or we can actually click to compare our investor profiles. And this will take us to a screen where we can actually compare conservative, moderate, and aggressive against one another. So here we go. So conservative, moderate, and aggressive. As I mentioned, we've got those historical returns, worst returns, average returns. It's telling us time frame up here, so at least 3 years, 5 years, and at least 5 years. And there's our asset mix as well at the bottom. So again, we can choose whichever one we feel is most appropriate for us and for our goals. So we may choose, let's just choose in this situation, to go ahead with the moderate profile. So we're comfortable with that. We think it meets our time frame. We're okay with that amount of volatility. So we're going to go forward with that as our selection. Now, keeping in mind, we can always come back and change that if we feel that we'd like to. So we'll save and continue here. Next thing is to just include any savings we already have or any accounts that we have that we'd like to use towards this goal. So you could choose your RSP, your tax-free savings, any cash or margin accounts. Just make sure to only include accounts that you're going to be using towards this specific goal. Now, in this case, since our balance is 0, let's assume that we're at least having a little bit of savings already. So we'll choose 10,000. And then also keeping in mind, are we going to make ongoing contributions? So in this case, let's just say we're going to be putting in $150 bi-weekly towards this goal. Again, we can always make changes to this at any time. So here is our projection based on our goal and the amount of money we're putting away, as well as our investor profile. Our money is expected to grow to $702,525 in that 40-year period. We are a little bit short of our goal of $1 million, but the great thing that we can do is we can make adjustments to any of these factors to try and bring us a little closer to our target. So let's just choose, for example, to increase our contribution amount. We'll keep it bi-weekly, click recalculate. And that's going to show we're actually getting a lot closer we're within 100,000 of where we'd like to be of our goal just by increasing our biweekly contribution by $50. So very easy to make some little changes here in order to kind of get a little closer to our goal. We could also kind of move the target age forward, move the target amount down. All of those things would help us to move forward. And again, keeping in mind, this is based on that investor profile we chose of moderate. So if we were to choose to go with an aggressive portfolio, then that also could potentially help us get to the goal quicker because it'll be a little bit more of a return. We're going to click start with this plan, and it's going to let us know we can view our goal details, track our progress over time, as well as set new goals. So we're going to click to go to our goal dashboard. This is where we can see that goal, our target, our projection, the current portfolio value, which will change and update as the market changes. And then we can click on view details again to get back to that and make any further adjustments to this portfolio. So again, it's going to show us how our portfolios are doing, what different accounts are included, as well as those different things that we can make adjustments to. Okay, hopefully that introduction of the goals tool can help our audience keep the big picture in mind when emotions are running high. And speaking of the big picture, let's find out the answer to our trivia question from earlier. As a refresher, the question was, an investment plan may help investors reach their financial goals, but emotional decisions can often interfere along the way. What percentage of investment gains can be attributed to an investor's asset allocation strategy? And the answer is, widely cited studies by researchers Brinson, Hood, and Biebauer suggest that an investor's strategic asset allocation is responsible for a whopping 80% of investment gains. Of course, an investor must be able to maintain that strategy over time to improve their chances of reaching their goal in most cases. That's why it can be helpful to complete a risk profile questionnaire to help you understand who you are as an investor, the risk tolerance you're comfortable with, and the behavioral habits you may have that can influence your follow-through with your investment plan. And being aware of how emotions and biases can creep into our minds and how we can aim to better manage them, as we learned today, may also be a huge help. So thanks again for your insights, Chantel. Now, without further ado, let's go over to our live Q&A.